Welcome back to the Ultimate Trading Podcast for beginner traders. I'm Isabel Maria, and today we're diving into a topic that every trader, whether you're just starting or have been at this for years, absolutely must understand: diversification. Yes, I know, the word gets thrown around a lot in investment circles, but today we're going to unpack what it really means from the perspective of someone who has lived through the ups and downs of the markets, experienced sector crashes, currency swings, and the kind of volatility that tests every ounce of your discipline. Let's start with the basics. Diversification is all about spreading your investments across different asset classes, sectors, and regions to manage risk and improve the stability of your returns. Think of it like this: if you put all your eggs in one basket and that basket drops off a cliff, you're in trouble. But if you spread those eggs across several baskets, some in equities, some in bonds, maybe a bit in commodities, a piece in real estate, you're giving yourself a fighting chance when the market throws a curveball. Why is diversification so important? First, it reduces risk. No matter how confident you feel about a single investment, the truth is, you can never fully predict the market. A concentrated portfolio can swing wildly, while a diversified one can absorb shocks more gracefully. Second, it stabilizes returns over time. You're not relying solely on one asset class or sector to carry you. Third, it exposes you to growth opportunities. Markets move at different speeds, and a well-diversified portfolio lets you benefit from the sectors or regions that are performing well. Finally, diversification helps mitigate the kind of volatility that can lead to panic trading. Different assets react differently to market events, and spreading your investments helps smooth out those fluctuations. Now let me tell you about a trader named Sarah, who learned this lesson the hard way, but in the end, turned it into a winning strategy. When Sarah started trading, she had a concentrated portfolio, almost entirely in technology stocks. Initially, she rode the tech boom beautifully. Her portfolio soared, and confidence was high. But then the market corrected sharply, and suddenly her gains evaporated. Her portfolio took a significant hit. That moment of pain was a wake-up call. Concentration had magnified her losses, and she realized she needed a more balanced approach. Sarah sought guidance, did her homework, and implemented a thoughtful diversification strategy. She continued investing in tech, but she expanded into healthcare, finance, and consumer goods. She added government and corporate bonds to stabilize returns, and even REITs to get exposure to real estate. Commodities like gold and oil became hedges against inflation and economic uncertainty. And she maintained a portion of her portfolio in cash and money market funds to preserve liquidity. But diversification didn't stop at asset classes. Sarah also diversified geographically, investing across the US, Europe, Asia, and emerging markets. She balanced her sectors carefully, so no single industry could wipe out her portfolio. She mixed investment styles, growth stocks, value stocks, dividend payers, to balance potential upside with stability. And she practiced time diversification, staggering contributions to reduce the risk of mistiming the market. Over the next year, the benefits became crystal clear. When the tech sector slumped again, losses were offset by gains in healthcare and consumer goods. Bonds and REITs added stability, while commodities like gold provided protection during economic uncertainty. Her returns were more stable, and the stress of watching the market swing wildly was dramatically reduced. Geographical diversification let her participate in growth markets abroad, while sector and style diversification ensured she wasn't betting everything on one trend. By the end of the year, Sarah's portfolio had not only recovered but was performing better than her old, concentrated one. She had achieved consistent returns, mitigated risk, and built a resilient investment strategy. So what can you take away from Sarah's experience? First, diversification is more than just spreading money around, it's about making informed, strategic choices. Regularly review and rebalance your portfolio to ensure it aligns with your goals. Stay informed about economic trends, geopolitical developments, and market conditions that could impact different assets. Don't hesitate to seek professional advice when designing a diversification plan tailored to your risk tolerance and objectives. And above all, be patient and disciplined. Diversification is a long-term strategy. It's about building resilience, not chasing instant results. Within each asset class, diversify further. Within equities, for example, hold a mix of large cap, mid cap, and small cap stocks from different sectors. Remember, diversification is your defense against the unknown, the unexpected, and the inevitable mistakes we all make as traders. It's what allows you to sleep at night, knowing a single downturn won't wipe out everything you've worked for. As Warren Buffett famously said, "Do not put all your eggs in one basket." That advice is timeless because markets are unpredictable, and your goal as a trader is not just to make money, but to survive and thrive through cycles of volatility. Before we wrap up, I want to leave you with a question to reflect on. How diversified is your portfolio right now, really? Are there areas where you're overexposed, or markets and asset classes you haven't explored yet? Take a moment to think about your own trading decisions, and consider what steps you could take this week to build a stronger, more resilient portfolio. Leave your thoughts in the comments. I love reading them, and they often spark discussions that help all of us grow as traders. Remember, diversification is not a passive strategy, it's an active, informed, and deliberate way to manage risk, capture opportunity, and navigate the markets with confidence. Stay strategic, stay disciplined, and keep building that resilient portfolio.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!